Hey everyone, Jordan Moorhead here with the Moorhead Team. If you're buying, selling, or investing in Austin real estate right now, you've probably heard the same narrative all year. Rates are coming down soon. Just wait it out. But today, I'm here to tell you that's the wrong conversation. The real conversation we need to be having in Austin and across the country in mid 2026 is this. Mortgage rates could legitimately go up from here, but ignoring that risk could cost you thousands or even kill your deal in the competitive Central Texas market here. Stick with me because the data, the Fed's own signals, and what's happening on the ground in Austin are flashing warning signs. Let's break it down. Step one here is the current reality. First, where are we today? So, as of early June 2026, the average 30-year fixed mortgage rate is right around 6.4 to 6.5%. That's after dipping lower here earlier in the year. We did get below 6%, and it's bounced back up even higher than where we are today. But that's where we're at today, is right around 6.5. It's better than the 8% peaks we saw in the last couple of years, but it's still punishing for affordability here in Austin. And a median home price of 500 to 600,000 at 6.5% means much higher monthly payment than most buyers remember from the 3% era. Everyone's waiting for the drop. But what if it doesn't come? Especially with Austin's strong job growth and steady demand. So here's why the risk of rates going higher this year is real and why you need to stop assuming they'll fall. Number one, the Fed's signaling possible rate hikes. In their June 2026 meeting, they held rates steady at 3.5 to 3.75%, but the dot plot removed all expectations for cuts this year and now sees the median rate ending in 2026 higher, with several officials open to at least one hike. It's because inflation just isn't behaving. Inflation is sticky and it's getting a boost. Geopolitical tensions, especially around oil and energy, have pushed prices up. Higher oil equals higher inflation expectations, which push treasury yields and mortgage rates higher. Experts are already noting this summer could see modest upward pressure if inflation stays the same. Treasury yields and bond market reality here. Mortgage rates track the 10-year treasury more than the Fed funds rate. So everybody hears, oh, they're lowering the Fed's rate. They don't necessarily track that. What they track is the 10-year treasury. If investors demand higher yields because of inflation or stronger economic data, mortgage rates follow, regardless of what the Fed does. Many forecasts have rates stable in the mid sixes for the rest of 2026, but others warn of volatility and potential increases in the second half of the year. The conversation has been too optimistic about cuts, and that affects Austin buyers every single day. So, what does this mean for the Austin market specifically? For buyers, if you're waiting for sub 6% rates, you might be waiting for a long time. Or worse, rates tick up and your buying power shrinks even more in a market where inventory is getting tighter. In desirable areas like Round Rock, Leander, and Central Austin, especially. Every half point increase adds hundreds to your monthly payment. For sellers, Austin prices have been strong in this year because of tech jobs, strong relocation still we're seeing. But if rates raise and buyer demand cools, you could see longer days on market, more negotiation, and prices potentially going down. You need to price very realistically now and get your home sold if you want to capture what might be the high value here in the next couple of years if rates go up. For agents and investors, stop telling clients to date the rate, marry the home. The smart play here in Austin is stress testing the deals to make sure they work at these current rates. Focus on cash flowing properties and growing suburbs, exurbs, or getting creative financing. Local factors like inventory, job growth, like all these tech companies that are moving in here still. Tesla, for one, is doing massive expansions in the Austin area. And then the property taxes, you have to factor those in and assume those are probably going to go up in the future too, rather than just betting that rates are going to go down in the future. Austin housing market isn't frozen because of rates alone. It's the uncertainty and wrong assumptions that are holding deals back. Here's what you should do right now in Austin. Run the numbers today at current rates. Don't bet your future on a rate cut. If the deal doesn't work now, it probably might not work here in the next couple of years. Lock it in if you're buying. Rate locks and buy downs can really protect you and make your deal look a lot better. Watch inflation data. Understand oil prices, next Fed meetings, and then focus on what you can control. Credit score, down payment, location of the property, and the property type. Make sure you talk to a trusted local lender. The Moorhead team works with the best in Austin for personalized scenarios, and they understand investing here too. Real estate rewards the prepared, not the hopeful, especially in a dynamic market like Austin with all the growth we have going on here. And the real conversation in Austin real estate right now isn't when do rates drop, it's how do we thrive even if they don't, or if they rise in the future. If this video helps shift your thinking, hit like, subscribe to the Moorhead team, and drop a comment. Are you buying in Austin right now, or are you waiting? What rate would make you jump in? I'll reply to as many as I can. Hope you all have a great day here, and let me know what questions you have. You can always reach me, jordan.moorhead@kw.com. Thanks for watching. Stay informed, stay ready, and I'll see you on the next one. This is Jordan Moorhead with the Moorhead team, your go-to Austin, Texas real estate investing realtor.